Hello everyone. Welcome back to Prime Accounting Classroom. In the previous lesson, we explained the key concept of amortization of intangible assets. Now it's time to move from theory to practice. Today we'll take practical, real-life transactions and record amortization step by step using journal entries and T-accounts so you can master it completely. By the end of this lesson, you will be able to record the purchase of an intangible asset, calculate annual amortization, pass the correct journal entries, post to T-accounts, determine the carrying amount on the balance sheet. Let's begin. Scenario 1. Purchase of a patent. Assume a company purchases a patent for $50,000 on January 1st. The patent has a useful life of 5 years. There is no residual value. This is a finite life intangible asset, so according to standards issued by the Financial Accounting Standards Board and the International Accounting Standards Board, it must be amortized over its useful life. Step 1. Record the purchase. When the patent is purchased, journal entry, debit, patent $50,000, credit, cash $50,000. Explanation: the company now owns an intangible asset, and cash decreases. Step 2. Calculate annual amortization. Using the straight line method, amortization per year equals 50,000 divided by 5 is equal to 10,000 per year. Simple and clear. Step 3. Record year-end amortization. At the end of year 1, journal entry, debit, amortization expense, patent $10,000, credit, accumulated amortization, patent $10,000. Notice carefully, we do not credit the patent account directly. Instead, we use a contra-asset account called accumulated amortization. Step 4. Posting to T-accounts. Now let's post this into T-accounts. Patent account, debit side, 50,000 purchase, credit side, nil, balance equals 50,000. The asset remains at historical cost. Accumulated amortization, patent, debit side, nil, credit side, 10,000, which is year 1 amortization. Balance equals 10,000. This account increases each year. Amortization expense, debit side, 10,000, credit side, nil. This appears on the income statement. Step 5. Carrying amount after year 1. On the balance sheet, patent cost equals 50,000. Less. Accumulated amortization equals 10,000. Carrying amount equals 40,000. This is also called the book value. Scenario 2. Second year amortization. At the end of year 2, we repeat the same entry. Debit. Amortization expense 10,000. Credit. Accumulated amortization 10,000. Now let's update the T-accounts. Accumulated amortization. Year 1, 10,000. Year 2, 10,000. Total equals 20,000. Carrying amount after year 2. 50,000 minus 20,000 is equal to 30,000. Notice the pattern? The cost stays constant. Accumulated amortization increases. Carrying value decreases gradually. After 5 years, accumulated amortization will equal 50,000, and the asset's carrying amount becomes 0. Scenario 3. Partial year amortization. Now let's make it more realistic. Assume the company buys software on April 1st for $24,000. Useful life equals 4 years. First, calculate annual amortization. 24,000 divided by 4 is equal to 6,000 per year. But the company owned it for only 9 months in the first year. That is from April to December. So we prorate. 6,000 by 9 divided by 12 is equal to 4,500. Year-end entry. Debit. Amortization expense 4,500. Credit. Accumulated amortization 4,500. Remember, very important in exams. Always adjust for partial periods. Scenario 4. Indefinite life intangible asset. Now let's test your understanding. Assume the company has a trademark with an indefinite life. Do we record amortization? No. Indefinite life intangible assets are not amortized. Instead, they are tested annually for impairment. So there would be no amortization journal entry. This is a common exam trick. How it affects financial statements. Let's connect everything clearly. Income statement. Amortization expense reduces profit. Balance sheet. Intangible asset appears as cost minus accumulated amortization. Cash flow statement. Amortization is added back under operating activities because it is a non-cash expense. Remember, amortization reduces accounting profit, but it does not reduce cash. Common mistakes to avoid: crediting the asset instead of accumulated amortization, forgetting to prorate for partial year, amortizing goodwill, forgetting that cost remains unchanged in the asset account. Final summary: let's quickly recap the full process. Record the purchase of the intangible asset at cost. Calculate annual amortization using straight-line method. Record journal entry: debit amortization expense, credit accumulated amortization, post to T accounts. Determine carrying amount, which is cost minus accumulated amortization. If you master these 5 steps, amortization questions will become very easy for you. If this lesson brought you clarity in every concept, don't forget to like, subscribe, and turn on notifications. See you in the next class.